One of the ways accountants analyze business transactions is by using T accounts. And in part one, which I linked above, I discussed the first 6 transactions of Eli's consulting services. In part two, which we'll focus on today, we'll analyze 6 additional transactions for Eli's consulting and continue to practice the concept of analyzing business transactions with T accounts and learning the concept of debits and credits. As a reminder, a T account is a visual of individual accounts in a company's general ledger. It's called a T account because it looks just like the letter T. The name of the account is listed on the horizontal line, with debits on the left and credits on the right. Just like a golfer might picture taking a swing before doing so, and a tailor pins fabric first before sewing, the accountant uses the T account to simulate what the transaction looks like once it is finalized and posted to the final accounting records. Just remember that every transaction needs at least 2 parts, at least 1 debit and 1 credit, and that the total debits must equal the total credits. As you learn about debits and credits, it's important to follow a systematic approach to identify which accounts increased or decreased and what account to debit or credit. I recommend that you follow this approach where in step 1 you identify what accounts increased or decreased, followed by step 2 where you classify the accounts that you identified in step 1 by account type, and in step 3 where you use the dealer mnemonic to find the debits and credits. Let's look at transactions 7 to 12 for Eli's consulting and apply this process to the analysis of business transactions with the use of T accounts. In the 7th transaction for Eli's consulting services, the business earned $36,000 in revenue from clients who paid cash for bookkeeping, accounting, and consulting services. When we analyzed this transaction using the accounting equation, we said that the business's cash increased because the business now has more cash. Cash is an asset, and assets, according to the dealer mnemonic, increase with debits. Since cash increased, we need to debit cash. What about the second part? Remember that every transaction has at least 2 parts, at least 1 debit and 1 credit. When we analyzed this transaction previously, we said that fees income increased. Fees income is a revenue account, and we can see in the dealer mnemonic that revenue accounts increase with credits. The revenue increased, so we credit the revenue account fees income. So debit cash, credit fees income. How do we write this transaction using T accounts? We find the T account for cash and write the transaction ID G and the amount of $36,000 into the debit column of the cash account, because we determined in step 3 that we would debit cash. The amount for the revenue account fees income increased as well. We learned in step 3 that revenue accounts increase with credits on the right side of the T account. We create a T account for fees income, write the transaction G and the amount of $36,000 into the credit column of the fees income T account. We completed the analysis of our 7th business transaction with the help of T accounts. Let's practice some more. In the 8th transaction for Eli's consulting services, the business earned $11,000 in revenue from various charge account clients. When we analyzed this transaction using the accounting equation, we said that the business's customers now owed money to the business. We call that an accounts receivable because these are accounts that the business will receive money from in the near future. Accounts receivable is an asset, and assets increase with debits. Fees income also increased. Fees income is a revenue account, and revenue account increase with credits. So we debit accounts receivable and we credit fees income for $11,000. Next, we enter the transactions into the T accounts. We create a new T account for accounts receivable with debits on the left and credits on the right, and write transaction ID of H and $11,000 into the debit column of the cash account because we determined in step 3 that we would debit accounts receivable. The amount for the revenue account fees income increased as well, and we learned in step 3 that revenue accounts increase with credits on the right side of the T account. We find the T account for fees income and write the transaction ID H and the amount of $11,000 into the credit column of the fees income T account. Let's move on to transaction number 9. In the 9th transaction, Eli's Consulting Services received $6,000 on account from clients who owed money for services previously billed. We previously analyzed this transaction using the accounting equation and said that the business's cash increased because the business now has more cash. Cash is an asset, and when assets increase, we debit the account. So we debit cash for $6,000. Accounts receivable decreased because the clients paid Eli's Consulting and reduced their debt with the company. Accounts receivable are an asset account, and asset accounts increase with debits and decrease with credits. Since accounts receivable decreased, we credit the accounts receivable account for $6,000. We'll now write this transaction into the T accounts, and we find the T account for cash, write the transaction ID I and the amount of $6,000 into the debit column of the cash account because we determined in step 3 that we would debit cash. The amount for the accounts receivable account decreased, and we learned in step 3 that asset accounts decrease with credits on the right side of the T account. We find the T account for accounts receivable and then write the transaction ID I and the amount of $6,000 into the credit column of the accounts receivable T account. Let's move on to transaction number 10. In the 10th transaction, Eli's Consulting Services paid $8,000 in salaries for the accounting clerk and Sergio Sanchez. In this transaction, salaries expenses increased. Salaries expenses are expenses, and the graph tells us that the expenses are on the left side and that expenses increase with debits. The business's expenses increase, so that means we need to debit salaries expenses for $8,000. The cash account decreased. Cash is an asset, and assets, according to the dealer mnemonic, increase with debits and decrease with credits. In this case, cash decreased, so we have to credit cash for $8,000. We'll now write this transaction using T accounts. We'll set up a new T account for salaries expenses and write the transaction ID of J and the amount of $8,000 into the debit column of the salaries expense account. Next, we find the T account for cash, write the transaction ID J and the amount of $8,000 into the credit column of the cash T account. Let's move on to transaction number 11. In the 11th transaction, Eli's Consulting Services issued a check for $650 to pay the utility expenses. We previously analyzed this transaction using the accounting equation and said that the business now has more utility expenses. Utility expenses are classified as expenses, and the dealer graph tells us that expenses are on the left side and that expenses increase with debits. The business expenses increase, so that means that we need to debit utility expenses for $650. The cash account decreased. Cash is an asset, and assets, according to the dealer mnemonic, increase with debits and decrease with credits. In this case, cash decreased, so we need to credit cash for $650. We'll now write this transaction into the T accounts. We'll set up a new T account for utility expenses and write the transaction ID of K and the amount of $650 into the debit column of the utility expense account. Next, we find the T account for cash and write the transaction ID K and the amount of $650 into the credit column of the cash T account. The last transaction, number 12, is up next. In the 12th transaction, Trade and Eli withdrew $5,000 in cash for personal expenses. Withdrawals are funds taken from the business by the owner for personal use. These payments are not associated with the business, but rather a return of the investment that Trade and Eli made into the business. Monies given to the owner are classified as drawings, and drawings according to the dealer mnemonic increase with debits. That is why we debit the drawing account for $5,000. The amount for the cash account decreased, and cash is an asset, and asset accounts decrease with credits. That is why we credit the cash account for $5,000. We find the T account for Trade and Eli drawing and write the transaction ID L and the amount of $5,000 into the debit column of the T account. Then find the T account cash and write the transaction ID L and the amount of $5,000 into the credit column of the cash T account. Now that we entered the last transactions into the T accounts, we can sort the T accounts into the assets, liabilities, and owner's equity categories. The next step is to calculate the total for each column of the T accounts and calculate the balance. Calculating the totals for each column is called footing. For the cash account, we have total debits of $125,000. We have total credits of $13,650 and a final balance of $111,350 after we subtract the credits from the debits. If there is only one debit or one credit, like in the accounts receivable account, you don't need to foot the columns, but rather just calculate the balance. Next is the trial balance. The trial balance is a listing of all T accounts with their debit amounts in one column and the credit amounts in another column. Accountants use it to verify the accuracy and completeness of the accounting entries by totaling the number columns. And if the total debits equal the total credits, accountants can now move forward in preparing the financial statements. In practice, you would run a system report that is called trial balance in your accounting software program. If the total debits do not equal total credits, which may happen in manual accounting, which is what we're doing here, we need to go back and fix our entries. In an accounting system, the total debits always equal the total credits in the trial balance because that is checked automatically. You wouldn't actually be able to record a transaction that doesn't balance. But as we're practicing accounting, it will happen to you all quite frequently because you'll forget to record one side of the entry or transpose a number. So here are a few tips for finding what transactions you might have recorded incorrectly. If the difference between debits and credits can be divided by 9, there is a transposition error. Like, for instance, you wrote 45 instead of 54, or you entered 3,500 instead of 5,300. The difference between 5,300 and 3,500 is 1,800, which is divisible by 9, and that would therefore be a transposition error. A slide is an error that occurs when the decimal point is misplaced. So you've entered one side as $375, and the other one is $37.50. Those are the typical errors that you might find. Other errors would be, for instance, you recorded a debit, but you forgot to record the credit. That's typical as well. That is why after the trial balance has been prepared, we double check that the total debits equal the total credits. For our trial balance here, the total debits of $150,500 equal the total credits of $150,500, and we're now ready to prepare the financial statements. So don't forget that important step. Double check that your debits equal your credits. Next are the financial statements. Let's start with the income statement. We go back to our trial balance. We enter the fees income of $47,000 from our trial balance. We enter the expenses for salaries expenses of $8,000 and utility expenses of $650, and then subtract the total expenses of $8,650 from the revenue of $47,000 and calculate net income of $38,350. We next prepare our statement of owner's equity, which requires us to start with the beginning balance of capital. As of December 1st, we have $100,000. We add that to our net income of $38,350 from the income statement, and we subtract that what Drayton Eli already took out of drawings of $5,000. And then combine the net income less the withdrawals, and then add that amount to the beginning balance, coming up with an ending capital balance of $133,350. We're now ready to prepare the balance sheet. We first list out all of our assets: cash, $111,350, accounts receivable, $5,000, supplies, $1,500, prepaid rent, $8,000, equipment, $11,000, for a total of $136,850. List our liabilities on the right side, starting with accounts payable for $3,500. We then list owner's equity, which we transferred from the statement of owner's equity of $133,350 for a total of $136,850. And we again see that our accounting equation, assets equals liabilities plus owner's equity, still holds true. $136,850 on one side and $136,850 on the other side. I hope this was helpful. Keep practicing, and before long, you'll feel confident in analyzing business transactions with the help of T accounts, the concept of debits and credits, and the preparation of financial statements.